watching a new episode of HomePlaceFlorida show, and I'm your host, Steve Feler. Welcome to HomePlaceFlorida Real Estate Insights, the podcast where we dive deep into the heart of the housing market. In today's episode, we're going to unravel the complex tapestry of real estate dynamics, dissecting mortgage fluctuations, saving strategies, and the reality of home affordability. Today, we're meeting with Nathaniel Bittman, mortgage lender and president of Florida Association of Mortgage Professionals. Today I have my guest, Nathaniel Bittman. And Nathaniel, thank you so much for joining me.
Pleasure. Thank you.
Today's discussion, Nathaniel is a mortgage broker, right?
Actually, I'm a mortgage lender.
Mortgage lender.
And I also serve for the Florida Association of Mortgage Professionals as a state president.
Great. So you have a chance to meet someone who really is into the industry, and yes. Nathaniel will help us to understand. Problem is today's market that it's always a problem, right? If you go back 10 years ago,
is there ever not a time that there's not a problem in the market, right?
Exactly right. So it's not like people thinking, 20 years ago was better than today, or 10 years ago was better than today. No, it's not true. People always had some issues, and industry always facing some issues. And for example, I think today's market is really affected by higher interest rate. And it's not because interest rate is that high. Looks like back in 80s.
Sure, the Carter era, Carter conversion into Reagan. Yeah, absolutely. So 18% interest rate. That's right.
18% interest rate. Many of our viewers who probably wasn't born that time, or maybe who was born that time, they wasn't definitely were not into the market.
Your parents were about your age, so
exactly right. So problem that we had almost a decade. Really low interest rate made people feel comfortable that it's a new normal, and obviously was not normal.
You're referring to the lower rate environment, the pandemic rate.
Pandemic rate or pre-pandemic rate.
It really started March 20th of 2020 when we saw that significant shift and the federal government started to make moves to drop rates, but just slightly right on the hinge of becoming a pandemic.
Obviously, the goal is, and what's federal government, this is one of the main tools for federal governments to slow down inflation. And inflation is when it's too much money on people's hand, and they start buying too many things. If you go back to 2006, 2007, when we had market crash for secondary mortgage, right?
Yes.
Subprime mortgages, and that was completely different story, because a lot of times, if you look in this right now on the internet all over the place, some people say, market will crash, we'll have huge correction, everything is done completely. I think saying market will crash is like keep saying, everybody will die, Yes, eventually, right? Eventually. You could be right or wrong. We're all under the gun. But the whole thing about market, it's always some little tweak or something that happens and why it happens. So, Nathaniel, can you tell what's your view on this situation today? And do you think maybe we're starting from the wrong end? Maybe we should go to a little bit deeper into other questions first. But I think a lot of people would be interested. What do you think?
With regards to which part, as far as interest rates are concerned, or the health of the market?
How's the market?
So I would tell you that in my honest opinion, I feel that, so I'll be celebrating 30 years in September having been in this business. So I've been through the 2006, 2007, 2008. It's an entirely different period in time because you saw, we really have to look at the construction market, Steve. That's what's very important. If you really want to know the health of the market, you have to look at construction. Construction dictates inventory. And when you go back to 2006, 2007, 2008, you saw massive construction with limited demand. So there was massive supply, limited demand, and because developers and builders were putting so much inventory in the market at that period of time, there wasn't enough of my generation to go around. May I ask how old you are?
Well, I'm 53.
I'm 52. So our generation, Generation X, we are one of the lowest populations in history in terms of buying power.
Yes.
So if you want to understand, let's talk about, I'm a man that's based on facts and data, not theory. So let's just talk about facts and data that dictates where we're going, to answer your question.
Right.
So if we look at, people want to reference that the collapse of this market is going to be similar to 08, 07, 09. What we have to look at is fundamental supply and demand. So my generation, your generation, we were the smallest population group that had the buying power at that time. Buying power in the residential business for people that get mortgages is between 35 and 42. So you got to figure that when we were at the peak of our buying power, we had the lowest population that was buying, yet the developers and builders were building the highest amount of inventory of homes. The builders got smart. They realized that. Now you see that builders and developers are not putting as much inventory in the market.
That is correct, because I think that one of the concern is, I think they're afraid if they put too much inventory in the market, first they're going to crush market.
Well, there's price controls a little bit.
Price control, right?
There's some price control. They don't want to oversaturate the market.
And second is the difference between privately sold home and builders, especially big nationwide construction companies. Again, it's my subjective opinion. It's like when they start the project, they have to finish project. Once they start digging land and building something, it's never favored for these special nationwide companies to freeze construction and not to build, finish build.
But they'll do them in phases, right? They'll do them a little bit at a time. You don't want to overpopulate the market. So there is some control there, and the developers and builders are very smart about that. So we have to realize that if we look at generation groups, the millennials and post-millennials, so the millennials and post-millennials will be the largest population, even to exceed the boomers in terms of buying power. So now you have limited inventory. You don't have developers and builders putting as much inventory into the market. You really are forced to go into, if you don't want to drive long distances to buy homes in rural or suburban areas, and you want to be closer to work or closer to city or municipalities, you have to buy resale homes, or you have to go custom builds, which are very expensive. So the one thing I would say is that is the rate a function of a slowdown in the market? Absolutely, because it deteriorates buying power. But the one thing we have to recognize is massive continuing population growth. We see internationally more people coming into the United States.
Right.
Correct? We see more growth in that area. The Hispanic community is growing. We see the international market growing.
That's one of the things that basically drive right now market. It's in international communities. You're absolutely right. It's a lot of people from different countries. They come in here from Europe, Asia,
Latin America,
Spain,
yes.
Right? They come here and which is a good thing, because if they come to United States, that means they believe in the United States. They believe in this market. They believe this is a good thing to invest here, their money. So that's definitely a good thing.
But to answer your question, we have to look at the facts and the data. The data supports continued massive population growth, limited inventory in the marketplace. So in terms of the interest rate does not really dictate that as much as people's affordability. Affording a home, being able to pay for it.
Okay, you say does not, right?
So in terms of, to me, the rate, people get stuck on a rate. Rates are at 7% or they're 7.25%. I don't want to buy until rates are at 5%. I think what people don't realize is when you look at the math, the difference from 7.25 to 5, if you take a $400,000 home, the difference from 7.25 to 5.25 is maybe about $250, $300 a month. It's not a significant difference.
It's not significant, right?
It's not a massive difference. You will spend more money going to Bonefish and having dinner or out to Carrabba's than you would. So, but there is a difference. We see the data shows that for every 1% drop in interest rate, there's a 10% increase in value of a home. So if a rate goes from 7.25 to 6.25, the value of that home will go up by 10%. So 400,000 goes to 440.
And that's open. That's very nice that you mentioned this, because it opens another question: is if somebody, like a lot of people say, oh, it's not a good time right now to buy because interest rate is higher, right? Mm-hmm. And you just answer a question and saying, if you buy today, and what we hear in the news that with the next, let's say, 18 months, Federal Reserve will drop prime rate, right? So we can go down, let's say, to maybe 6% or 5.5. That's mean that people will be able to refinance and get better deals. So they're not really locked.
No.
It's nothing to afraid, and it's nothing to afraid that if you really just bought today and you're paying higher, you can always drop interest rate within.
Of course, the good news is, if we take taxes and insurance out of a payment, so we're just going to do only mortgage payment. If you take a mortgage payment and you are in a loan today, and if you're at 7%, that payment is fixed for 30 years. It's not changing.
Yeah.
Right? It's not changing. That's the good news.
That's good news, yes.
What's even better news is that when rates drop, you can always lower that payment.
And again,
so you're not going to go up. You're just going to go down.
That's very true. That's
right?
exactly.
Where in other countries, depending on where you come from, there's no such thing as a 30-year fixed rate product. Everything is adjustable rates, from my understanding.
And you don't have here, and you don't have most of the time prepayment penalties. So if you decide to refinance, or you hit the lottery and decide to pay off your house, nobody will penalize you. You just paying off, and probably bank will be more happy that you paid off earlier. So
absolutely. I mean, what country in the world provides you such a tremendous opportunity that you can have a fixed payment for 30 years and build an asset and create equity and wealth?
So what would be recommendation right now for people who, because I have, for example, I have a lot of people who's sitting right now in their current interest rate, low interest rate, and
3%. Yeah.
3%, right? And it's really hard. And even myself, I bought my house that I'm living right now in lower interest rate, and it's hard to swallow to give away that house and start paying something more and increase my monthly.
Increase your payment, your monthly payment. So the belief is that people will not go from 3% to 7%, but they'll go from 3% to 5%.
Right.
Now, it's not that big of a swing. A 2 percentage point swing in a mortgage may be just a few $100s in an example. So if you're looking to make a lateral move, you want to be a move-up buyer, maybe you want to move to another location, the data supports movement at 5.25. People are okay to spend a little bit more money on the rate. They don't want to jump double, almost triple, but they're okay to go up a little bit. So in terms of is the question, why would somebody go from 3% to 7% today?
Right.
Okay. To me, the reason is, and people might think I'm crazy here, but as an economist, this is how I believe. I believe the higher the interest rate, the better the environment is, because the higher interest rate gives you, the buyer, negotiation power. So the higher the rate, the less competition. For those of you that are watching this, think of the thousands, the tens of thousands, nationally, the millions of people that are waiting for rates to come down, because that's the mindset. I want to wait for rates to come down so I have all this extra affordability, then I'm going to go look for a home. What they don't realize is when they do the math, it's only a few $100s of a difference. So to me, the higher the rate, it's a myth, but people get stuck, they get paralyzed. They don't want to come out and buy a home. Homes sit on the market longer. It gives you, the buyer, more negotiating room.
By the way, this is really good advice. And even if you buy new homes, brand new construction companies, what I noticed is they give you some incentives
Sure.
to buy. So they may not drop price on the paper, but they give you some back incentives to.
Absolutely. They'll give you incentives to lower the rate. They'll give you incentives to pay for your closing costs. You know, we're in Florida, and in Florida, you have to have housing. There's no other place to go. So we are also in a peninsula, depending on where you are here in our market. But you're exactly correct. Why would you not want the incentives? Because again, the payment is fixed.
Right.
It can always go down.
Nathaniel, one sensitive question, and I think it's a lot of people have this in their minds, and I hear people talking about this internally. I have friends, I have family, I have read different articles. The inflation spin that we had already last decade we had a couple spins of inflation.
Yes.
And right now we're going to, and again, doesn't matter, you're critical or you're not critical. I'm not talking specifically to you, I'm just saying in general. Viewers,
yeah, sure.
about what government does about inflation, increasing interest rate. Every day, people, when we go to supermarkets, you noticing that pack of eggs or gallon of milk, all necessities become more expensive to buy, and a lot of people complain that, well, their income did not increase. So that's a pain of the inflation. So when they purchasing house, right, and everybody wants to have what they call American dream, right? What we call American dream is buy a house, be the owner of the property. I think more important is to understand and not overestimate your income and what you should pay for a house, because everyone wants to live in a mansion. Everybody wants to live in the most expensive, beautiful house, but when people buy, and that's what usually when I represent buyers, I'll usually recommend them. You don't want to be what they call house poor, right? So you don't want to spend your entire income on mortgage payment.
On your home payment.
Right,
Yes.
right. Let me grab water. So that's basically one of the things, like when people apply for mortgage. I'm sure mortgage industry also watching for this. Yes, let's say you pre-qualify for $700,000 maximum, right? But does it mean you need to buy a $700,000 house, or maybe you should consider something smaller, and then who knows? You change your job, you open your business, you hit lottery, whatever it is.
You might be surprised in my answer. I appreciate where you're going with that. So my recommendation is the first thing you need to do as a consumer is you really need to look at your budget. There are many times that I talk to consumers that want to buy a home and they want to live in a $500,000 home, $500,000. Right. And when they look at the payment, they see that the payment is too high for a $500,000 home.
Right.
And they can afford it. They can afford it, meaning they could qualify for the loan. They qualify, but they don't want to pay it. When I get their bank statements, what I see in their bank statements is they've been to Disney, they went to Carrabba's, they went to the mall, they bought an extra pair of Nike sneakers, they got some sandals, they bought an extra 6-pack of beer, right? They bought all of these things that aren't necessarily essentials. They may have a boat, which is a depreciating asset. They spent more money on a car, which is a depreciating asset. So when I look at people fiscally, what I'm seeing is that they're spending frivolous money for a lifestyle. What they're not doing is they're not creating wealth. In my opinion, if you can afford if you can qualify for a $700,000 home, and I agree with what's the definition of house poor? Does house poor mean you don't go out 3 days a week to restaurant meals? Does house poor mean that you don't carpool once a week and save some money on fuel? Does house poor mean that you could live with one car, but instead you want 2 or 3? Does house poor mean you have to have a boat? So that's really the description. If you can afford a $700,000 home, or you can qualify for it, get it, because here's the reality. We appreciated this year 6.1% So even at rates at 7.5%, 8% this past year, homes in Florida still appreciated 6%. So a $500,000 home went up to 530. $1 million home went to $1,060,000. So the higher the value of the home, the more you're going to get out of it. I'm all about creating real estate wealth.
Yeah, that's absolutely right. And I think you just answered exactly.
It was a long answer. It was a long answer, but it was an answer that you really need to think about. If I see your bank statements, where are you spending your money?
But Nathaniel, you just opened, I don't know, you want it or you didn't want it, but you opened the whole can of worms, I would say, about this, because
You're welcome.
I think our generation,
Yes.
right?
Mine and yours.
Mine and yours,
Yeah,
exactly
yeah.
right. We had much less to spend. We basically, if parents buy us a bike
Yes.
or a soccer ball, right? And that would be the greatest gift
Yes, yes.
you ever want, and you can go on and just go to your friends and be happy and play. These days, because of the market, because I think people become generally living better, or I think every generation lived. They're good and bad.
Or maybe faster, right? If you look at your phone and all of a sudden Temu pops up, or you talk about microphones and all of a sudden you see on Instagram and Facebook, shop this, look at that. How many people are clicking on that shop now button and buying things that they really don't need?
They really don't need. Exactly.
Right?
And they really don't compare, don't take time to compare if they can buy the same product for, like, you can buy a pair of sneakers for $500 or $300, or you can buy
wash your sneakers and reuse them, or buy the whiteout stuff that makes your sneakers look white again. Why do you have to have 8 pairs of sneakers?
I can give you a little secret. You can buy sneakers for $20, and they will be probably the same equal quality.
That's right.
That you pay $200.
Yes, exactly.
And
Did you pay $200 for sneakers when we were kids? I don't remember that. My grandmother took me to Alexander's, and my sneakers were $6.
I don't know. I wouldn't even open my mouth to ask for this.
Okay, yeah. We didn't buy Nikes when I was a kid.
It's not just about specific brand. It's just about that you want to see something, you want to get it.
That's right.
You want to.
And speed, Amazon, Temu, right? Speed. I can have it tomorrow by 6. When you and I watched commercials when we were children, and we saw an ad on TV, we had to go to the store to buy it.
Yes. Now it's very easy just to click.
So think about this as a consumer. Really think about this. Why you have to look at your bank statement. We don't have a comprehension of money. So $20, bing. $30, bing. $15, bing, 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 right? We don't think about that. You need to look at your bank account almost every day and see where you're spending money, because you'll realize at the end of the day, you might have spent $700. You thought you spent $70, but you really spent $700. For 30 years, I have worked with tens of thousands of consumers. 80% of the time, when I go over somebody's bank statement as a mortgage professional, when I sit with couples, they look at each other and they go, we had no idea we spent this much money. We had no idea.
Listen, you can get a cup of coffee in the morning, make it at home, or you can buy for $5 a cup of coffee.
Right, that's right.
Think about this.
Yeah, people know this.
People know this.
But why do they do it? Why do you think people do it? Why do they spend the $5 for the coffee?
I think it's trend and convenience.
Yes.
And I think that's probably, I don't know, do you know any other reasons?
I think you're right. I think it's trend. I think it's convenience. I think you see a Starbucks and your salivary glands, you get a dopamine hit, you get excited about the idea of driving through and getting a Frappuccino. But look at that, add that up. It really adds up.
Yeah, and it's not against that you need to go Starbucks or McDonald's or any other brand. Of course, we're all humans, we all want something, and you can go there once in a while and get some. But if people make it as a hobby to spend, because I can pull up my credit card and just go and don't think that I need to pull hard cash and pay right now. You don't feel that you really don't understand the value. You're losing a sense of value of the money. And
so now think about that. If you could find, to answer your question, because we're talking about housing and where should you buy, if you could save $500 a month, if you really look at what you're spending, it's another $500 a month. That could be the difference of buying a home with a pool or without a pool. Now you have a pool. Now you can buy all the things you want. You could save money, not go out to dinner, and you can have a beautiful weekend at home, swim with your pool, invite friends over. To me, when you buy a home with a pool, you actually long-term save money.
That's right. And you know what else is? You're absolutely right. The people, I'm sure everybody heard it, depreciation value or appreciation value.
That's right. They buy depreciating assets.
The difference is if you buy new fancier TV that you really didn't need it because your old TV is still working very well.
Right, that's right.
Because somebody told you in a commercial that it's the best since last year.
This TV will talk to you. Yeah,
Yeah,
you know,
exactly.
tell you what to do.
Do you really need that TV, or you just want the TV to show off in the front and have something fancy hanging in your living room, right? That TV will cost half a price and maybe 1/3 of the price in a few months, and so it's basically
depreciated
value, right? The
Yeah.
same thing goes to cars. Same thing goes to
Boats,
anything.
cars, clothing, electronic devices, phones.
Exactly, they're losing value.
$2,000 for phones now, right? In some cases, is that right?
$2,000. Exactly.
Some phones, sure. The Samsung Galaxy Fold is $2,000. It's crazy.
It's crazy. It is crazy. But if you buy a house, if you invest, if you learn how to save money and invest in houses, that's appreciation. Because in 10 years from now, you'll say, hey, you know what? I'm so glad I followed that advice. I'm so glad I did this because now I own something that I can sell it and maybe spend, I can lease it, or I can leave it and leave it to my kids, leave it to my family.
You can move and rent it out. You can create some real estate wealth. You can buy a home, live in it for 2 to 3 years, create some equity, borrow against the equity of that home, buy another home, rent that home out, and continue to build equity and wealth. Absolutely.
Speaking of creating equity and wealth, I think we should probably have a total separate episode for this because this is a really long conversation.
Oh, it is a long conversation. Yes, you're right.
But again, a lot of people hear this, oh, I'm an investor, I'm buying this. Investor, when you have cash or when you have at least significant amount that you can put so you can make profits from your investment. But when you completely finance your house, just hope that you can rent, usually,
Yeah.
a lot of people don't understand it, but there's a little rule, this rule of 1%, right? When you lease your property, right? So
That's correct.
If you buy a house, and that's what I recently spoke to somebody about this. If you buy a house for $700,000, beautiful house, beautiful, you need to make sure that you rent this house for monthly $7,000.
Right. That's right. That's correct. There should be a variance for that. Now, to your argument and to your point, you are correct. Here is where the interest rate and higher price values can be a problem for certain investors to get that 1%. That could be, so we have to be honest on the other side of it, that could be a challenge. I think we're mostly speaking to people that are renting or people that are looking to make a move upwards or people that are making a lateral move. If you're looking, my point is to the consumer that doesn't own a home. If you don't own a home, budget, buy a home, and you had some conversation about inflation and affordability. I think that most consumers can afford it, they just don't want to pay for it. Now, there are some that can't afford it. You can, I get that. But for those that can but don't want to pay, those are the ones where I think we really should be talking to.
Yeah. So I think we should have a separate conversation.
Yeah, we can because we could really get deep on that. There's some good data on that.
Well, I appreciate Nathaniel. Thank you so much. I appreciate that you took time to meet with me today, and I think we created really nice podcast today to talk about different things that people think every day, and people have in their minds, and they really didn't have significant information about this.
Do you think that we should cover anything about projection of rates moving forward to the future, inflation? Because you had some concerns about that. Did I address those questions for you?
I think you should. Yeah, I think it's a good idea, yes.
I think it's good for people to know. So we want to talk a little bit of strategy to leave it on people's
minds.
minds.
We touched at the beginning, right? But
yeah,
you need to.
But we need to wrap. So we'll do a quick wrap up on that. So in terms of inflation, what I think that everybody needs to understand is that the federal government is working on trying to correct inflation. So you're talking about eggs and milk. That is a very big concern. So the federal government keeps the federal funds rate higher, which is the money that banks use to borrow from the federal government to manufacture goods and services.
Right.
So if I want to make more Pepsi cans, but I got to have aluminum, and I have to borrow money to buy the aluminum to make the Pepsi cans. If it costs me more money to buy the aluminum, then the price of Pepsi cans are going to be more expensive. So a company will borrow money from the federal government or the bank, that's where the federal funds rate comes in, to make products and goods and services, which is why we pay more for milk, eggs, so on and so forth. So the federal funds rate doesn't have an effect on mortgage rates. The federal funds rate is car loans, boat loans, credit cards, manufacturing costs. So the federal government is keeping rates high to make things more expensive so that people will stop spending money. If they stop spending money, then prices will come down. So that's really important. If you want to know what's going to determine interest rates to come down on mortgages, if inflation comes down, that means the value of money actually goes up. It becomes more scarce. It becomes more valuable. As the value of money goes up, interest rates come down. So we believe that the federal government, and economists believe, Fed Chairman Waller, Fed Chairman Powell, the Federal Reserve believes that we should be able to get inflation a little bit more under control by the end of the year. So really by 2025, we should start to see rates starting to really come down. In my opinion, now it becomes too late for you a little bit, because now as rates come down, the value of homes goes up. So if you want to negotiate closing costs, negotiate the price of a home with a seller while rates are still high, now is the time to do it, because next year it might be a little bit too late.
That's a great point.
So that's my theory on inflation, what we believe.
I think it's great theory. Nathaniel, thank you so much.
My pleasure.
I
Thank
appreciate
you.
it,
It's my pleasure.
and
Thank you.
We see you next time.
Thank you. Have a nice day.